Devina Mehra as well joins in on the show to share with us her outlook. Devina, good morning. Good to have you on board. You've been saying this time and again, harping on the fact that the rupee depreciation remains a clear and present danger, and that sure is playing out.
Yes, it is. I've been saying it now since Diwali last year that this is the risk for 2022. I mean, risk as well as opportunity for some. But that was quite clear even before the commodity, big rally or the Russia-Ukraine conflict. Of course, off late, the RBI made some efforts, and so you've just seen a slight moderation, but that overall trend will continue for some more time.
Yes, indeed. And that is something that you've been talking about for quite some time. But just get in a sense as to what you're advising at the current juncture for equity investors. If we were to look at, some of the big moving parts, the crude oil price fall has been a clear advantage for the Indian equity markets. But you didn't see that much euphoria play out, although now we are seeing a solid catch up. What do you make of the crude price move and how it's likely to play out? Do you believe that we also need to see other moving parts really change in order for the overall market sentiment to turn?
So since you mentioned commodity prices, this has been quite an interesting time because they say that now week is a long time in politics, but this time a fortnight has been a long time in economics also. So, 2 or 3 weeks ago, if you'd asked everybody in the business that what would you like to see, and that would have been the moderation of inflation. And that has happened at least from the commodity end, which is where this whole thing started in the first place. So if you look at metals, for example, from the beginning of the year, all industrial and precious metals are negative or near negative. If you look at agri-commodities, which was fueling a lot of inflation around the world, including in India, there's been a great deal of moderation in that. Cotton is down 35-40% from the peak. Wheat is down 40%, though that doesn't directly impact India. And also palm oil has cracked big time, so that helps prices of edible oils. And also almost a lot of other agri-commodities, barring soya and corn, which still remained high, but they are also coming down quite rapidly. So the only part of the commodity basket which still remained up was oil and gas, but that has also come off its high. So we don't think, our guess is that crude might well remain range bound rather than come down very sharply or go up very sharply. But it doesn't look as if it will come down a lot more, but whatever it has come down, obviously it helps India, besides the fact that India may not always be buying at that quoted crude level. But these other things of food prices coming down will help. This palm oil and certain other things coming down will help FMCG, for example, who use that as an input. So overall commodity prices going down is good news for India. But, these are all, you can say, excuses that you use as triggers. It also depends on where the market otherwise wants to go. And as I've been saying that India will be an outperformer this year, and that also has been playing out. We still think India is one of the better markets to be in. And as I spoke on your channel last time I was here, that the risk in the market right now probably isn't not being in the market, whether India or globally, especially the US, because now you were in a phase where the markets had come down a lot, and the danger was on missing out on big up moves. That was the thing, because our analysis showed that in 40 years you miss out on 10 big up moves, you give up 2/3 of your returns. If you miss out on 30 up move days, you give up 90% of your returns. 30 days in 40 years. So that 15% compounding that you're looking for from equity just disappears if you miss out a few good days. And those few good days normally come after a big correction. So that is something, again, still in terms of broad things to keep in mind, that still remains that now is the time to be back in the markets.
Sure. Devina, I'm going to touch upon US in just a bit, but just to probe further about, the agri-commodity cool-off that you were just reiterating towards. Uh, Tactically, good news for consumers because FMCG stocks, even non-movers like ITC, we all know what they've been doing for the last 6 months actually now. Or would you say there is a bit of a catch here?
No, that is definitely going to help FMCG in two ways. One, of course, is that the consumer basket, uh, some of the other components, as the prices come down, there is more room for FMCG purchases, which was what was happening in the previous few months, was that people were postponing not just consumer durable purchases, but even things like shampoos and all that, which was showing in the declining volumes for FMCG. So FMCG, after a very long period of underperformance, which has lasted over a year and a half, now is looking better. So that definitely, and we do have some FMCG names now in our portfolio, and including you mentioned ITC. In fact, that was the first one to come back into our portfolio just some weeks and months back. So that has played out well for us.
It sure has. We are all counting down to 300 rupees a mark on ITC now, aren't we? But besides FMCG, Devina, where else do you see leadership emerge in this kind of an inflationary environment in the market here in India?
The sector that we are most overweight on is capital goods, industrial machinery. I mean, that just came out of the stocks, but that's the sector that I was just seeing that we are most overweight on. Somewhat overweight, we still have the rupee depreciation theme. So there are parts of textiles, parts of chemicals, and we still remain somewhat overweight on IT services. So that has been something I've spoken about several times. So those would be the broad things, barring some telecom, some a few other odd things. But in terms of sectors, this would be the, and of course, yeah, the other big change other than FMCG sort of coming back in has been in the auto, especially the four-wheeler space. That has been looking good for a while, and again we have increased weight there.
Okay, you've increased weight within the auto space as well. What's on the radar as well is banks of late, and I understand that you've remained fairly circumspect or underweight, if I may, on this sector as a whole. Walk us through the rationale. Does nothing appeal even within the large cap financials?
I mean, we do have holdings in banks. So we do make a choice in banks, and particularly the PSU banks right now have been looking somewhat good. But I mean, we are nowhere close to the index weight still. And as I said, we are always a little careful because of the prospect of negative surprises in this sector, because this is a highly leveraged sector where you don't really know on a granular basis what they have done, where the skeletons are, and the skeletons once in a while stumble out. So that is the part that we are careful on. But we do have bank holdings, and in the large banks, some of them. So, but we pick and choose.
Right. But, in the banking space, are you now incrementally positive because, fintech has started to get cautious? They are losing, new capital if they need to gain market share, and credit growth overall from RBI data is picking up. So do you think all these things are positive for the traditional banking names?
Well, the fintechs also often the money was coming from the banks, or at least that was one model where they were the originators and the lenders were still the banks. So that may or may not change things that much. And I don't think that was necessarily the only constraint that the banks were facing. So that part, I mean, the interest rates going up again, as I've spoken before, normally is good from the point of view of repricing of assets first. What you lend gets repriced first before the deposits, but it hits you on the bond book. But I think RBI will once again come up with something so that they don't have to take a complete hit on the bond book, which is the way it usually has happened in the past. So as I said, we are a little more positive. Like if we look at last year or the year before, we barely had any banks. We had a very negligible weightage, especially compared to the fact that the index has such a high weightage. So now we are at a much higher weightage than we used to be, but we are not overweight. We don't intend to be overweight.
Right. In terms of India versus rest of the world, most of the strategists that we have spoken to are constantly pointing out to one thing, that India remains one of the great stories over the next 5 years. If you're a long-term investor, you should buy. So, what is that correction level or Nifty level that you would look at before you start to allocate more to India?
Well, I mean, this the next 5 years belong to India. I've been hearing for the last 30 years since I've been in the market. So that's why I'm smiling. So this story you can give at any point in time. But as I said at the beginning, and as I've said earlier also in my earlier interviews, that this year India is going to be an outperformer. That's our bet. And that comes out of the fact that before 2021, for a number of years, India was an underperformer. If you look at the global rankings, India used to be number 20, number 24, number 22. That was the range. And 2021 was the first year after a very long time that it was part of the top 10. It was number 6. And that outperformance trend still continues. As I said, this is one of the handful of countries that we like still as an outperformer when we look at the global stance. So that part still remains. And the other part which you were saying, that whether it's time to get back in, yes, it is time to get back in, whether you're looking at a global allocation or whether you are an India investor looking to allocate from other assets back into equities.
Devina, is there merit in worrying about the US recessionary environment right now? Soft landing, hard landing, I don't know. None of us can guess that. But if that were to be the case and the US were to be headed into recession, which seems to be the alarm and warning signals from pretty much all corners, then in that case, would you challenge India's outperformance? Or would you say, if that were to be the case, the flows would definitely find their way into EMs and there India would be a big beneficiary?
See, my outperformance bet is not contingent upon whether the flows come or not. Again, this is something I've reiterated many times. That is not what determines the direction of the market. And the first time the FII's flows came in was the only 9-year period in Indian stock market history that we saw zero returns. So that you cite that. As far as the US recession is concerned, yes, the probability of a hard landing has been increasing. So, I mean, the inflation moderation has come on the other side with concerns on growth. So, which is why I say that, be careful what you wish for, that you wished for lower inflation, but that has come with all these other add-ons. So this is the part that you need to be careful on, that you don't, but that does not directly impact India, that part, that fine that there might be a recession. But again, even in the US, maybe it's already priced in. I mean, NASDAQ has been about the worst performing index in the whole world this year. So again, that it just doesn't depend on how the economic situation is. It also depends on how much has been priced into the markets. So the flip side, of course, to having a slowdown coming faster and larger than what had been anticipated will be that the central bank, particularly the Fed, would put the brakes on the rate tightening earlier than anticipated. So already the markets are pricing in that the final, that what they call the terminal rate for the Fed, will not be as high as it was earlier anticipated to be. So there are many moving parts to watch, even on commodities or what happens to global growth. China lockdown or reopening, all that has an impact. Now, China has suddenly now announced a stimulus package, which again changes the or may change the demand dynamics for many commodities, and that again might have an impact on global inflation. So this is a time when many variables around the world have to be watched. Currencies have to be watched, and the Fed is more hawkish than the European Central Bank. So if you see the euro dollar, the euro is almost at a 20-year low against the dollar, or maybe it's cracked it. I haven't seen yesterday's closing. So
Okay, Devina, always good chatting with you. And we didn't get a chance to speak about when your and my favorite actor got married, and now he's becoming a dad too, Ranbir Kapoor.
Good luck to him.
Okay, we'll catch up some other time on that one. But good to have you on the show, Devina, as always.